So when it comes to investing your pension or other savings into the stock market, you're going to need to make a decision on whether you use investment funds or you invest directly into shares. Now, the world of investing doesn't have to be scary once you understand it. And it doesn't need to be high risk either. At the end of the day, this type of investing means owning some of the great businesses of the world, the companies that you buy from every day, the businesses that are at the forefront of innovation and solving society's problems. Now, it is vital that you invest money that you plan to hold for the long term. Otherwise, the effects of inflation are going to eat away at your money and ultimately make you poor over the long run. And this is going to mean you lose future choices and options. So in this video, we're going to look at whether it's right for you to use investment funds or to invest into shares directly. And we're going to go through the pros and cons of each. My name's Carl. I'm a regulated practicing financial advisor and also investment fund manager. Welcome to the channel. In these videos, I'm trying to get across tips and information that will help you find true financial independence so you can really go out and enjoy yourself. We cover topics such as retirement planning, pensions, investments, and tax saving. When you choose between investment funds or buying shares directly, ultimately you will end up owning the same thing, and that's shares in publicly listed companies. Companies that are listed on stock exchanges around the world. You may be familiar with some of these stock exchanges already, ones like the London Stock Exchange or the New York Stock Exchange. Now, some funds will even give you access to private companies that are not listed. The main difference between an investment fund and buying shares directly is that when you invest in the fund, you don't actually own the underlying businesses. Instead, you own shares or units in the fund itself. Your money invested into the fund is pooled together with lots of other investors, and then the fund will go out and buy shares in lots of different companies. Those collection of shares that the fund owns will be called its portfolio. The price of the units you hold in the fund will reflect the underlying prices of the share portfolio the fund holds. So, for example, if you had invested into a fund that held just 2 shares in 2 different companies, and on a particular day those 2 shares both went up by 5%, then your overall return for the fund is going to be 5%. However, on a different day, if one of those shares went up 5% but the other share went down 5%, then your overall return for the fund would be 0. You'd be at break even. Funds are run by people called fund managers, and the bigger the fund, the bigger the team supporting them. The market is now full of hundreds of thousands of different investment funds, and there are lots of different names that you might hear for these different types of funds, including open-ended investment companies, also known as OICs, unit trusts, investment trusts, exchange-traded funds, also known as ETFs. In America, they usually refer to funds as mutual funds. Now, we haven't got time in this video to explain the differences between all these different fund names, but ultimately, they all do the similar sort of thing. Each fund must clearly state its objectives so you know before investing what the fund is trying to do. There will be funds out there that just focus buying shares in particular countries. So you may have a fund that just purely buys UK listed companies, or you might have a fund that buys purely US listed companies. There are also funds out there that don't care about which country the company is based in, but they're focusing more on particular sectors. So one particular fund might just focus on buying technology companies, for example. And there's also funds out there that are very generic. They basically invest in businesses across the world, across sectors. Now, there are 2 main investment management styles out there for funds. We have active funds and active fund managers, where the fund manager believes that they can beat the market that they're operating in. So they believe they have the required skill to identify companies in the country that they're investing in or the sector they're invested in. And they believe that by honing into just a couple of these companies, they can beat the overall market return. And on the other side, we have passive or index tracking funds, where the fund manager doesn't attempt to beat the market. It essentially just buys all the companies that operate in that particular sector or operate in that particular country and deliver the overall market return, which is essentially the average of all the companies operating in that space. The large majority of funds are regulated, meaning they have to follow certain rules set out by the financial regulator. And some of these rules include the approval of the fund manager themselves. So there's certain qualifications and skills that a fund manager needs to prove to the regulator before they're even allowed to manage a fund. There can be restrictions on how much the fund can invest into one particular company. So you can't have a fund that basically just holds a couple of holdings. It's going to need to diversify quite a bit. There's rules on the appropriate fund documentation. So when you're researching funds, you should see all the information displayed in a standardized way, which the regulator has forced upon fund managers. This just will help you, compare funds like for like. And there's also rules on advertising restrictions. So, funds again can advertise, but they have to advertise in a certain way, using documented, templated performance figures and things like that. And the idea of all these rules are to protect investors at the end of the day. Now, there are also some funds that are unregulated, which of course means less restrictions on how they can invest, but it does then bring more risk to investors. Now, if you don't go down the investment fund route and decide to instead buy and sell shares directly yourselves, then of course you're going to need to set up a stockbroker account. And once you have your stockbroker account set up, as long as you have enough money in the account and you can afford to buy the share at the price it is, then you can be a proud owner of a piece of that business, as long as you've got enough money in the account to buy the share and also the associated costs involved with it as well. So let's now have a look at the pros and cons of each, the pros and cons of using investment funds versus shares. And we'll start with looking at investment funds and the pros for investment funds. So the advantage of using investment funds. Okay, firstly, if you're going to use a fund, you may benefit from the expertise and skills of a particular fund manager who may know and understand the market you want to invest in much better than you. Okay, next, using the fund is going to require a lot less of your time, because it's the fund manager that's going to go out there, do all the research on different companies to buy, and ultimately they will decide which shares they buy. So you didn't need to get involved in any of that. So another advantage is that it's good for people that are not that experienced in investing or don't have a lot of knowledge in investing, particularly good for beginners, because again, the fund manager is going to take care of everything for you. Now, a fund is going to hold lots of different shares in lots of different businesses. So we call this diversification. And diversification is going to help minimize your risk, because there's not a very big chance that every single business in a particular fund is going to go bust. So there's very little chance that you're going to lose all your money by investing in a fund. And it means you can achieve this diversification at a much lower cost, because if you had to go and buy, the potentially hundreds of different shares that are involved in one fund, it's going to cost you a lot more to do that yourself. And with funds, it's usually very easy to get your money back whenever you need it within a couple of days. Most funds are what they call open-ended. So when you request your money back, they just cancel your units and pay you your money back. You don't need to wait for a buyer of your units. Another perk of a fund is that there's no capital gains tax if the fund manager decides to sell a share that has made a large gain. So no capital gains tax is paid on sales by the fund manager, only potentially once you sell units in the fund. And that's of course if it's not in an ISA or a pension. And finally, we have the fact that funds are mainly regulated, so that does give you a bit more consumer protection. Okay, let's look at the cons of investment funds. Let's look at some of the disadvantages of using funds. Okay, the first one is that there's going to be an ongoing fund management costs. So because you're using the services of a fund manager, they're obviously going to charge you for it. And this is usually a percentage of the money you have invested with that fund on an annual basis. So this is of course going to reduce your overall returns over time. Another con, we spoke about diversification earlier, but sometimes too much diversification can reduce your overall returns, because it means your winners can be dragged down by your losers who end up with more of the market average. And whilst regulation can be a good thing, it also weighs down on a fund manager. So it restricts what they can invest in. They might have found a really good company they want to invest in. They put the money into that company. The company does really well. And at some point, they're going to be forced to sell down when they might not want to, because there's restrictions on how much they can hold in a particular company. And by buying and holding lots of different companies in the same sector, which obviously achieves that diversification, but it does expose you to market risks. So if there's a particular problem throughout the entire market or sector that you're invested in, or the fund's invested in, then you're obviously going to get caught up in it. The fund's going to get caught up in it, and ultimately returns will be dragged down. Another issue with funds is that there's hundreds and thousands of them to choose from. So it can be difficult to know which fund is best for you. So you still have to spend time trawling through all the different funds. And finally, fund managers do change jobs. They come and go. Some even stay but change the fund objective. So you do need to keep an eye on what's going on with a particular fund. And if you see that your fund manager has left, has the structure or the objective of the fund changed significantly? Because they can do. Okay, let's move on and look at owning shares directly. So the pros of shares. So firstly, it's going to allow you to have direct access to ownership in a piece of a business. And this could be a business that you really understand. It gives you the potential for the full upside of owning that particular share, but of course also the full downside if it doesn't go right for you. You can concentrate your portfolio in just a few select number of stocks that you're comfortable investing in, which may be more risky, but could give you a greater return in the long run if it works out for you. By you choosing your own shares, it allows you to focus on just the companies you understand. You won't have to include lots of other businesses that you might not know anything about because the fund has to diversify. And for those that have a passion for it, it can be fun researching companies and delving into all the nitty-gritty financials and trying to understand what the business does. If you really enjoy that sort of stuff, then you'll enjoy managing your own share portfolio. And there are lots of different websites and free information out there. So pretty much nowadays, if you want it, you've got the same access that a fund manager can access. They don't have any particular advantages over you when it comes to the research and information that's available. You just need the time and skill to analyze it. And when it comes to investing in shares, generally the charges can be a lot lower, particularly on an ongoing basis. And some stockbroker accounts even offer fixed fees now on an ongoing basis. Okay, so looking at the disadvantages or the cons of investing into shares directly, the big one is the fact that you have got the potential of losing all your money. So if you buy a share in one business, there is always the risk that that particular business could go bust and you could lose everything. This is less likely, like we've said earlier, to happen with a fund because the fund is always diversified across a couple of hundred different shares. It can be harder to diversify your portfolio if you're buying all your own shares directly because it's going to take a huge amounts of time to research and analyze lots of different companies, and the charges are going to be significant if you keep buying lots and lots of different businesses. Of course, we said earlier, some people might love it, but researching shares does take a lot of time if you're going to do it properly, and it does require a skill level, some understanding of business and particularly finance. Now, there are usually higher charges to buy shares initially, so a lot of stockbroker accounts charge a fixed fee to buy a particular share, and there's also stamp duty tax involved as well. Whereas when it comes to buying units in a fund, there's not usually the upfront initial charges, but the ongoing charges can be more, and the ongoing charges for shares can be less. It can sometimes be difficult to sell shares in a particular company if there is no market available for buying those shares. So sometimes if you invest into very small companies, they might not be very popular and there might not be a lot of shares actually available on the market. So if you come to want to sell in that particular company, you're relying on a buyer to be available to buy those shares off you, and sometimes that might not be the case. And finally, capital gains tax. If you're in charge of your own share portfolio and it's not within an ISA or a pension, then every time you sell shares, if those shares have made good gains, you will be liable to capital gains tax, which is obviously going to then reduce your overall return. So we've run through the pros and cons of investing in shares or investing into funds. But at the end of the day, there is no right or wrong answer. It's what works for you. And it's mainly going to come down to whether you have the time, inclination, or skill to manage your own portfolio of shares. If not, then funds are definitely going to be the right option for you. I would also say investing in funds is probably a good start for investing beginners because it will give you the time to find your feet and understand how everything works. A good overall solution could be to use a bit of both. So you could put the bulk of your retirement pension money into funds, like global equity funds, but perhaps on the side have a small share portfolio that you manage yourself, just so you get the opportunity to do your own investing. But if things do turn against you or go wrong, you've made some bad picks, you've still got the bulk of your retirement funds safely invested in funds in the global equity market. But the key thing is that you do invest, particularly long-term investment money, pensions in particular. You've got to invest that money so you beat the overall effects of inflation. I hope you found this video useful. Please don't forget to subscribe to the channel. If you found some value out of the video, I'd really appreciate it if you give the video a like, and do add any comments below if you've got any questions or any feedback. Until next time, take care.